Good morning, I'm Bill Blain, Strategist here at Shard Capital. This morning, let's talk about the new G7 tax agreement. What does it mean, and will the agreement on global tax ever become a reality? Well, what I can definitely say is this is a great time to be a tax accountant. The G7 agreement on a minimum corporate rate of 15% will have accountants, tax planners, and bankers in an absolute euphoric state as they anticipate just how they're going to dissect the deal's underpinnings with a fine-tooth comb, look for all the back doors, engage lobbyists to push for advantageous clauses, and get set to arbitrage every single facet of it. And that's even if the agreement ever happens and becomes a reality. If any European country ever receives anything close to a check for 15% of the profits made by a big digital tech company selling in their borders, I'll eat my hat. I've already heard that there is a note from one of the accounting firms suggesting how Amazon will be able to wriggle out of the deal completely because of the marginal cost calculations. Whatever, something which governments have set, which gives the right to tax 20% of profits exceeding a 10% margin, sounds a bit of gobbledygook to me, and it sounds much less than the 15% of profits to be taxed, which we all expected this agreement was going to achieve. But that doesn't really matter because this is a win-win for everybody. The Sherpas of global finance, like US Treasury Secretary Janet Yellen, are on the wires saying it's a revival of multilateralism and globalization as nations come back together in the post-Donald Trump era to solve critical challenges facing the global economy. The politicians, of course, they're all over it like a rash, looking forward to all that lovely US tech money to spend, while claiming to have righted a massive historical injustice in the lack of cash that's been paid by many of these big tech firms. The French, well, of course, the French are slightly different. They're complaining that 15% is not enough. President Macron is looking to demonstrate his fraternity with the working class voters who go to the polls next year in France by pushing for an even bigger take of corporate taxes. As for the corporates, well, I doubt they're that worried. In fact, they will be delighted. It's a chance to show they support the good cause, while behind the scenes, they'll keep emptying our wallets. Now, what about national tax agencies? They aren't going to bat an eyelid. They know better than to go for the big tech firms. They're too heavily tooled up with the best tax lawyers. It's much easier for the HRMC, Her Majesty's Revenue Collectors, to go for small businesses. They tend to cave quicker to their threats. But a big question is, will the agreement ever happen? On the face of it, it's the Irish who have most to lose, and they probably aren't that happy. They aren't even a G20 member, let alone G7, except through being part of the EU, which meant, of course, they were represented at the agreement meeting over the weekend. This morning, they're putting a very brave face on the story, with comments like how their low-tax economy will continue to attract jobs, and why would any already established company in Ireland there get up and leave? I think they're probably right. Many corporates aren't going to feel any urgency to move their operations out of Ireland, which they set up there because of the low taxes. Many may decide to beef up their operations in the expectation any tax deal is probably still years away from full ratification by all members of the OECD, and it may not happen at all. Thinking about it, if I see any weakness in Dublin office space prices, then that might be a good bet. There's nothing like a well-educated English-speaking workforce to attract foreign companies. And the reason why I doubt that we may see the agreement quickly exercised is the other big news over the weekend in the USA. A Democratic Senator, Joe Manchin, broke ranks to express his outrage at Democratic proposals to end the US political gridlock, which is caused by the use of the filibuster, which basically means you can talk out any piece of legislation. He also objected to plans to reform the electoral registration process, calling it divisive and polarizing. Many Republicans are praising Machen as a new messiah of reasonableness. But that was all occurring even as the beast of Mar-a-Lago was stirring. Donald Trump spent 90 minutes over the weekend haranguing his supporters yet again about how his election victory was stolen, but more importantly about how he intends to deselect Republican candidates he considers unworthy. Now, are we seeing the Republican Party in the States up in arms against Trump's big lie and his assault on democracy that we saw in January? No, the whole party leadership are increasingly complicit in the hope of Trump's ongoing patronage. Now, anyone with any experience of history will know that Donald Trump is likely to prove to be a crocodile that will eat them all. The reality is that for the new G7 minimum tax proposal to work, it needs US approval. And that's going to struggle to get through the slough of despond that is the deepening US political gridlock that's developing post-Trump. The Republicans are already parroting Trump that the deal can't be good for US company revenues, therefore it can't be good for America, therefore it should be rejected out of hand. But let's just assume that the discussions will continue. What will the proposed G7 tax deal mean for markets? Well, it's going to be a very busy time for the credit agencies. They're going to have to figure out what the shock horror of corporates actually paying taxes in countries where they sell stuff will actually mean. It could well push a few names down a credit notch or two because paying taxes comes before you pay back bondholders. Bondholders are subordinated to tax collection agencies. I'd be surprised if they find that many lame ducks. It's far more likely to be rising interest rates that kill zombie companies than tax demands. But the credit agencies won't miss the opportunity to make themselves very relevant. And I fear that they will no doubt start pumping out research for bond managers to fall asleep over on the implications of the tax agreement. It will all be terribly exciting stuff, as I say, to fall asleep over. But what about company profits? That's the stuff that once got everyone excited in the equity market before the new reality that it's not profits but growth that matters. Well, as one wag once pointed out, if you're paying taxes on profits, you ain't doing it right. Many companies will see the wisdom of that comment and they'll look to spend their profits on growing their business through acquisitions, on infrastructure. Heaven forbid they'll end up paying their staff anymore. Company spending of that form is an economic multiplier, so you can say it's a good thing. But at the same time, many acquisitions go badly wrong. And there's one thing guaranteed to make corporates make mistakes, and that's giving them too much money to go out and spend. And that may happen if they are threatened with taxation on their profits. And that leaves us with one final interesting thought. Over the last 10 years, we've seen US tech firms like Apple building up enormous cash piles. They built these from the untaxed profits channeled through corporate headquarters in nations that were willing to charge very low tax rates, like Ireland. Retroactively taxing these untaxed gains isn't ever going to be on the agenda, which means many of these companies are sitting on massive cash piles. What are they finally going to do with it? Will it ever happen? Anyway, that's some brief thoughts on where this market is going. Thank you very much for your time, and we'll be back with another Lite-Bite in the very near future.